Hi, I'm Ashi, the founder and CIO at IME Portfolio Managers. In today's presentation, I'll take you through the investment thesis of IME Concentrated Microtrends, a PMS strategy that focuses on taking concentrated exposures in value generating microtrends. Now, to understand the strategy, we first need to define what a microtrend is and why microtrend investing can be so powerful. In every market cycle and in every economic environment, there are always certain pockets of the economy where the bulk of value creation is happening. Some parts of the market grow faster, scale faster, and generate stronger earnings growth, while other parts move slower and dilute overall market returns. A microtrend is a specific subtrend within a broader macro trend or sector that has the strongest visibility of growth and value creation. Macro trends are long duration broad drivers. For example, India's structural reforms, formalization, demographic dividends, digitization, or rising incomes. Sectors and industries are the classification buckets, like financial services, healthcare, capital goods, consumer, technology. A micro trend is narrower. It is where the action is actually happening within these broader buckets. Let's take an example from financial services. Financial services benefits from macro trends like structural reforms and demographic tailwinds. But within financial services, you have many different industries: banking, NBFC, capital markets, insurance, and more. And within those industries, there are micro trends, specific sub pockets where conditions are unusually favorable, where earnings acceleration is likely, and where value creation visibility is higher. For example, one microtrend could be asset quality normalization in corporate facing banks. If you look back at the period from around 2015 to 2020, many corporate banks had to recognize large amounts of stressed assets. That led to high provisions and weak earnings. Once the credit cycle cleans up and bad loans are recognized, the earnings profile can improve sharply because the drag from provisioning reduces and the base becomes cleaner. That shift from pain to normalization can itself be a microtrend because it creates a strong multi year earnings tailwind. Another microtrend could be the financialization of savings, the structural movement of household savings from physical assets and informal channels towards organized financial products and platforms. So the difference is important. We are not saying financial services is the theme. We are saying within financials, which specific pockets have the best visibility for value creation over the next 3 to 5 years. And one more critical point: microtrends are not necessarily sectoral or thematic. Some microtrends can actually span multiple sectors because they reflect a broader shift in the economy. The focus is not on fitting into neat classification buckets. The focus is on identifying the most powerful pockets of value creation. The idea behind microtrend investing is simple. If you can identify the specific subtrends where growth and value creation visibility is strongest and take concentrated exposure to those trends, you can meaningfully outperform broad indices or diversified portfolios because diversified portfolios inevitably carry exposure to slower moving parts of the market. Our strategy is built to deliver superior risk adjusted returns by taking a concentrated exposure to these microtrends. Very often, managers attempt to generate outperformance by increasing small cap allocation or taking exposure to lower quality businesses. That can sometimes work, but it also significantly increases risk, higher volatility, weaker governance, and greater fragility in down cycles. Our view is that you can aim for strong outperformance in a more disciplined way by concentrating only in the parts of the market where value creation is strongest, while still owning high quality businesses. Now, why does this matter for returns? Because history shows very clearly that even in periods when the market does well overall, the bulk of wealth creation often comes from a small number of sectors or subtrends. We can see this clearly with multiple case studies. Take the 2002 to 2008 bull market. Overall markets did very well. The BSE 500 delivered roughly a 40 plus percent compounded return over that period. But the big driver of that cycle was capital investment, the capex and capital goods theme. If you had taken concentrated exposures to capital goods through that period, you could have generated far higher compounded returns than the broader index. Between 2010 and 2020, private sector banking was a major microtrend, driven by market share migration away from PSU banks, combined with stronger execution, better underwriting, and stronger franchise quality. Another example, between 2008 and 2015, healthcare meaningfully outperformed the overall markets. Between 2008 and 2013, consumer staples outperformed strongly, especially because that was a period of relatively weaker growth and higher uncertainty, and defensives performed better. It is important to understand that these are case studies, and in investments, things are always predictable in hindsight. But the point is not hindsight. The point is that markets consistently create outsized value in specific pockets. And if you can identify those pockets with discipline, you can potentially improve outcome meaningfully versus a broad exposure. And this is really the heart of the strategy. Identify the pockets of higher growth and stronger earnings visibility. Build concentrated exposure and hold with a 3 to 5 year lens while staying disciplined on quality and valuation. In terms of portfolio construction, the portfolio is designed to hold a concentrated set of roughly 20 to 30 companies built across 5 to 8 microtrends at any point in time. The microtrends themselves can evolve as the economy, the cycle, and the opposite opportunity set changes. Now, coming to what we are invested in today. Currently, we have exposure to roughly 8 to 9 microtrends. I'll give you a quick overview of what they are and then explain the thought process within each. Within financials, we have microtrends such as asset quality normalization, high quality lending franchises, and the financialization of savings. Outside of financials, we have exposures to themes like skill driven exports, digital disruption, aspirational real estate, manufacturing resurgence, and consumer premiumization. Before I go into each, I want to highlight one important thing. When you look at the actual companies in the portfolio, these are not obscure, low quality names. The portfolio is dominated by large, credible, mature businesses, companies that most serious investors would recognize. That is by design. Because when you combine microtrend tailwinds with business quality, the overall volatility tends to be more controlled and the risk adjusted return profile becomes more attractive. Now, let's go through the key microtrends. First, asset quality normalization. This is based on what happened in many corporate facing banks in the last cycle. Gross NPA ratios rose sharply in the 2015 to 2020 period as stressed corporate assets were recognized. This forced banks to take heavy provisioning, which compressed profitability and dragged on earnings growth. As the system cleans up, NPAs reduce, provisioning pressure normalizes, and return ratios begin to improve. The result is that earnings growth can become materially stronger, and valuations can re rate as the market gains confidence that the worst is behind. This micro trend includes holdings such as SBI, Axis Bank, IDFC First Bank, and Shriram Finance. Second, lending franchises. This is about owning structurally strong, high quality lenders that have demonstrated consistent underwriting, consistent growth, and resilience across cycles. Banks like HDFC Bank and Kotak are good examples of franchises that have compounded steadily for long periods without major accidents. And as weaker parts of the system struggle, market share tends to migrate towards these high quality franchises. In addition, these management teams tend to be more dynamic, more willing to adopt technology, and stronger on execution. This microtrend currently includes holdings such as Kotak Bank and ICICI Bank. Thirdly, financialization of savings. There is an ongoing strong secular trend with significant amount of household savings in physical assets moving away from these towards equities and insurance. This provides a strong tailwind to intermediaries, exchanges, wealth, and asset managers. with penetration of financial products in India still substantially below that of global levels. This theme has a very long growth runway. We currently hold 361 HDFC AMC and HDFC Life in the financialization of savings microtrend. Fourth, consumer premiumization. This is a well understood macro story for India, but our focus is on identifying the companies best positioned to capture the next phase of aspirational consumption. As India's per capita income rises, discretionary spending tends to accelerate. Globally, when companies cross the $2,000 per capita income mark, discretionary consumption often rises sharply, and we expect similar patterns to strengthen in India over the coming decade. There is also a generational tailwind, a larger young population entering the workforce with different preferences and spending habits than prior generations. And importantly, penetration levels across many consumer categories in India remain well below those in developed markets, which creates headroom for sustained growth. In this microtrend, we hold companies such as Titan, Britannia, M&M, and Jyoti Laboratories. Fifth, the manufacturing resurgence. This is a structural opportunity driven by global supply chain de risking away from China. And the PLI incentive scheme has created a more visible pipeline of incremental investment in selected manufacturing segments. In this microtrend, we currently hold companies such as Bharat Electronics, Ultratech, and Triveni Turbine. Sixth, digital disruption. We are optimistic about digital platforms in India, so much so that we also run a dedicated strategy focused purely on listed digital platforms. But digital disruption also naturally fits into the microtrends portfolio because it is one of the clearest pockets of long duration growth and value creation. We see a strong foundation for continued penetration of digital services, sustained growth, and a path towards meaningful profitability as these businesses mature. And as profitability emerges, value creation can be substantial. In this microtrend, we currently hold companies such as Nykaa, Zomato, and Policy Bazaar. Seventh, skill driven exports. India's STEM talent is one of the most important factors in our economic growth story. Across IT, manufacturing, engineering, and other sectors, where knowledge driven IP becomes crucial, we see India playing a crucial role. We hold Infosys and L&T Tech in this trend. Eighth, aspirational real estate. We are confident about the real estate opportunity, driven by a combination of affordability and formalization. This sector has gone through a long phase of disruption and cleanup, including demonetization, RERA, the NBFC funding shock, GSC, and COVID, all of which pressured small and weaker developers. This has led to a faster than expected formalization of the sector, with weaker developers exiting and market share migrating towards large organized players. This creates a clear microtrend: value migration to branded organized developers. In this microtrend, we hold companies such as DLF, Keystone, and Shobha. This is a quick overview of the microtrend strategy and the kind of companies we own today. It is also important for you to understand IME's underlying investment philosophy, the twin engine framework, since this is the core of what drives the identification of the microtrends and the companies that we seek to invest in. Essentially, the twin engine framework recognizes that there are only two core reasons behind all stock price changes: a change in earnings and a change in multiples. Some investors focus primarily on growth, buying fast growing companies without sufficient regard for valuation. Others focus on valuation, buying cheap companies without sufficient confidence in growth durability. Our experience across cycles suggests that the most consistent and asymmetric outcomes occur when both engines are aligned. Strong earnings growth with improving or stable valuation multiples creates compounding. Weakness in either engine materially reduces investment outcomes. An important element of the twin engine framework is that this leads to a strong quantitative rigor and discipline to stock prices. We have clearly identified target prices for all companies that we hold, based on our assumptions of how earnings and valuations are likely to move over the next couple of years. Not only does this give us great clarity on the reasons behind why we are holding a stock, but it also leads to superior investment and sale decisions. Let us now understand both of these earning engines in greater depth, beginning with the first engine, earnings growth. Earnings growth is the most important long term driver of value creation, since not only does earnings growth directly impact the growth engine, but an improvement in the earnings growth outlook also typically leads to an improvement in valuation multiples, the second engine. Over long horizons, stock price follow earnings. Accordingly, we do place a very high level of focus on the growth outlooks and changes in the same. Our research on Engine 1 focuses on identifying high quality, repeatable, and durable earnings growth, not just headline growth rates. We break this into five core dimensions: growth tailwinds, strategy and execution, competitive dynamics, profitable growth, and predictability. At a financial level, we analyze how earnings growth is generated via revenue, operating leverage, and or financial leverage. Our goal is to identify asymmetric earnings drivers where incremental growth leads to disproportionate profit expansion. The second engine of returns comes from changes in how the market values a company's earnings. Valuation multiples are not static. They change as the market reassesses growth durability, business quality, industry dynamics, and more. We focus on five drivers that can lead to structural changes and valuation multiples: growth rates, sentiment, moats, capital allocation, and quality. Our focus is to try to get a detailed assessment of how valuation multiples are likely to change over the next couple of years. And are they likely to add to or subtract from the boost in company value due to earnings growth? This chart helps you gain a better perspective on the kind of companies we are likely to buy and what we will avoid. Growth is clearly a clear focus, and we typically only buy companies where we see an attractive medium to long term growth outlook. The ideal companies are those where we also expect a valuation re rating, since both engines are firing simultaneously. But we are also willing to invest in growth companies where we expect valuations to hold up. We do not seek to invest in companies without adequate business growth, even if valuations are very tempting. We also do not seek to invest in high growth companies where we believe valuations capture all the upsides and are at risk of reducing over our investment period. Thank you for listening. If you'd like to discuss the strategy further, you can reach out to us via our website, imepms.in, or WhatsApp us at +91 8088 770050, and we'd be happy to connect. Thanks once again.